Look, most people out there think you need to be glued to the stock market every single day to actually make any money. You know the exact feeling, right? Staring at your screen, watching prices jump all over the place, stressing out over every tiny dip, and just ultimately feeling completely out of control of your own financial future. Well, a guy named Josh realized the exact opposite was true. The more he obsessively watched those prices swing, the more stressed out he became. So he took a step back and asked the surprisingly simple question. What if he took $100,000, put it into a dividend portfolio, and just let it generate stable income, like income you can actually rely on? Today, in this explainer, we're going to break down the exact step-by-step process of building a portfolio that's designed to pay you month after month without you ever having to sell a single share. To really understand how he pulled this off, we have to look at how Josh completely flipped his mindset. Instead of chasing these crazy fast daily market swings or trying to guess the next overnight tech explosion, he asked himself, what if my money actually had a steady day job? Not something wild and unpredictable, but something incredibly boring, incredibly predictable, and absolutely powerful. He wanted money that would just keep growing in the background even when he wasn't paying any attention to it. He wanted steady, reliable income. And that fundamental mental shift, that's exactly what leads us straight to the power of dividends.
So here's our roadmap for today's explainer. We're going to cover the dividend mindset, the exact portfolio blueprint, the traps you absolutely must avoid, and then we'll peek inside the actual portfolio before looking at the mind-blowing 30-year math. Let's dive right in.
All right, section 1, the dividend mindset. It's all about building that steady income. Okay, so the absolute core engine running this whole steady income machine is something called a DRIP, a dividend reinvestment plan. By setting your account to automatically take your dividend payouts and use them to buy more shares of the exact same stock, you're essentially building a massive compounding snowball. Now, at first, it honestly barely feels like anything is happening at all. But pretty soon, those extra little shares you just bought start earning their own dividends. It's like your money is having babies, and then those babies are having babies. Time does all the heavy lifting for you, and your portfolio just organically feeds itself without you having to lift a single finger.
Moving on to section 2, the portfolio blueprint and the strict rules of the game. You see, Josh didn't just throw darts at a board. He established incredibly strict criteria before investing a single dollar of that $100,000. These rules are what build a bulletproof foundation. First up is stability. We're looking for businesses with a rock-solid long record of steady profits, no matter what the market is doing. Second is dividend history. We want companies that maintain, or even better, actively raise their payouts year after year after year. And third, the payout ratio. This is absolutely crucial. It measures how much of a company's profit actually goes out as dividends. If they're paying out 90% of their profits, well, that's incredibly fragile. We want a healthy payout ratio below 60%. That ensures the dividend is totally sustainable and isn't going to get slashed the second times get tough. Now, to keep things nice and simple, Josh divided his $100,000 into 4 crystal clear equal slices of 25% each. First, dividend ETFs, which give you instant, massive diversification and act like a stabilizing anchor. Second, your blue chip stocks. These are the massive established companies with totally consistent earnings. Third, REITs, or real estate investment trusts. These guys are actually required by law to pay out most of their earnings, and they often pay monthly. And finally, the fourth slice, growth-oriented dividend stocks. These might pay a little less today, but they have huge room to grow their payouts down the road. The beauty here is that no single stock or sector can ever dominate. It's just perfectly balanced. Which brings us to section 3, avoiding dividend traps and protecting your system. Listen, even with a beautiful, perfectly structured blueprint, the market is full of mirages. Things that look like incredible deals but are actually massive, gaping pitfalls. And one wrong move can quietly weaken and eventually completely break the system you've worked so hard to build. If you let greed or impatience take the wheel, you're not just risking your dividend income, you could lose your underlying capital too. So what are the absolute biggest mistakes beginners make here? Let's walk through these specific traps really quickly. The single biggest one, chasing high yields. If a stock is suddenly offering a massive, unusually large dividend, you need to see that as a glaring red flag. It almost always means the company is secretly struggling and their stock price has totally tanked. That dividend is a trap and it could vanish tomorrow. Next trap, expecting every single stock to pay you monthly. Most companies pay quarterly, and that's totally normal. Third, not diversifying enough across your sectors. If you dump everything into tech or real estate and that specific sector takes a dive, well, your income dives right along with it.
And finally, taking the cash payouts too early. When you're in the wealth building phase, interrupting that drip snowball effect is quite literally the fastest way to kill your long-term growth. Just don't do it.
All right, the fun part. Section 4, inside the portfolio. Let's look at the exact stocks. Okay, so here are the actual key players that survived Josh's incredibly strict screening process. For our ETF anchor, we've got SCHD, the Schwab U.S. Dividend Equity ETF. It aggressively screens for high-quality, totally predictable companies. For our blue chips, we're looking at household names that just print money in literally any economy. Procter & Gamble, Coca-Cola, PepsiCo, Johnson & Johnson, and AbbVie. For our REIT slice, we have Realty Income, ticker symbol O. This one is amazing. It boasts a very solid 5.67% yield, and it pays out every single month. And for our growth slice, we've got Air Products and Chemicals, Nexstar Media, and Consolidated Edison. Every single one of these names has a very specific job to do in the portfolio. Now, the real genius of this setup is how combining those quarterly pairs with a monthly REIT creates this unstoppable year-round machine. Because let's face it, dividend income rarely arrives in perfectly equal monthly slices, but notice how Realty Income acts as a sort of bridge here. It pays out $47 every single month in columns 1, 2, and 3, without exception. Then those blue chips and growth stocks drop their heavier quarterly payments in alternating months. So you've got Procter & Gamble hitting in January, Nexstar in February, Coca-Cola in March. It just smooths out the cash flow beautifully across the entire calendar year.
So what does this actually look like when the checks start clearing? Well, in year one, this fully invested $100,000 portfolio generates an average of $295 a month. Now, I know exactly what you might be thinking. $295 a month isn't exactly buy a private jet money. But hey, that is not the point. That's enough to easily cover your groceries, a phone plan, or a utility bill without you lifting a finger. And remember, we aren't building this for instant gratification. This is only year one. This is just the tiny seed being planted.
And that leads us perfectly into Section 5, the power of compounding. Let's fast forward.
Look at the truly explosive growth that happens over time when you just let that drip system do its heavy lifting. We started with a totally modest $295 a month in year one. But by year 10, those reinvested dividends have aggressively pushed your monthly income up to $830. Now you're starting to cover rent or major insurance premiums. But just look at year 20. Your totally passive monthly income skyrockets to roughly $3,000 a month without working a single extra hour at your day job. Your dividends alone can start covering massive living costs, like a full mortgage. The snowball has officially turned into a full-blown avalanche. And honestly, here is the absolute best part. It's not just your monthly cash flow that's growing. Because you're constantly buying more shares, and the underlying value of those strong, stable companies naturally tends to rise over time, your total portfolio value is absolutely skyrocketing too. By year 1, you're sitting around $111,000. By year 10, it's pushing $288,000. And by year 20, you are looking at a portfolio worth about $870,000. The compounding effect has just completely taken over the math at this point. Okay, so where does it ultimately end up? Well, if you let this run all the way to year 30, the ending balance reaches a frankly staggering $2.76 million. Keep in mind, most of that massive value isn't created early on. It's created exponentially in these later years. And at this point, the portfolio is paying out over $10,000 every single month in pure dividend income. That's over $124,000 a year. At this level, Josh doesn't just have a little help paying the electric bill. He has the total option to step away from work entirely if he wants to. That is absolute financial freedom, built purely on a system of boring, predictable, highly disciplined rules. So I really want to leave you with this final thought to chew on today. Take a hard look at your own money and ask yourself, are you building a portfolio that actually works for you, or are you building one that you constantly have to work for? Always checking prices, stressing over the news, constantly managing trades. Because true wealth is having a system that just quietly hums along in the background, aggressively growing your net worth while you go out and actually live your life. I really hope this explainer sparked some serious curiosity about how you can start putting your own money to work. Keep learning, keep organizing that financial blueprint, and I will see you in the next explainer.